Hello everyone. Welcome back to Kenspire Business Mantra. Friends, in the last 15 episodes, you have seen the various aspects in terms of preparing for your business and how you have to approach the various dynamics of business. Now, in this episode, we'll be talking about financing strategies and banking arrangements, which is an extremely important step. So, welcome to this financing strategies and banking arrangements episode. Friends, finance is the fulcrum of any business, and that is a very important ingredient for the success of any entrepreneur. And any amount of focus and clarity will not be misplaced in managing this. Right? Having decided what business I'm going to do and what scale and what kind of organization and everything, we have to arrive at what kind of funding that is required in executing our plans. When we talk about funding, there will be two kinds of requirements. One is one-time setup cost. Other thing is working capital requirement. If it is a manufacturing company, setting up of the plant, machinery, factory, building, and so on and so forth. And of course, working capital requirement in terms of handling the materials, your receivable and things like that. Now, in terms of a trading company, it's pretty simple. Your one-time cost is going to be very less. Initial administrative expenses will be there. Initial setup cost will be there. Otherwise, it is just a working capital management. Now, it is very important to understand many businesses fail because they have not planned their funding properly well before commencing the business. So even before I start my operations, I should be clear about my financial closure. What do I mean by financial closure? This is the money required. This is where the money is going to come from. That clarity should be there. What is my own investment? What is it I'm going to depend on bank for my loans, or is there any other source of funds? This clarity should be there well before commencement of your operations. So this is called financial closure. Now, Capex funding normally can be from own sources or from a long-term debt, long-term loan you take from a bank with appropriate moratorium for principal or a period of time. When it comes to working capital, again, you need to arrive at your design, financial design for your business model. What is the lead time for your working capital? For your raw material procurement, and how many days of materials you need to handle? What is your WIP cycle? What is going to be your finished goods supermarket, which we already saw in the earlier episode? And what is the credit period you are going to give to your customers? When you are ready with all these information, it is easy to calculate the net working capital requirement. Another important factor in working out net working capital requirement is the credit arrangement you are going to have from your suppliers, right? Sometimes, interestingly, I've seen in some businesses negative working capital situation, which means I enjoy 30 days credit period with my suppliers, whereas I'm expected to give only 15 days credit to my customers. There could be certain situations like that where theoretically and technically you don't need any extra working capital support at all. You need to be able to manage within the existing resources itself. Whereas if it is a typical requirement of excess of fund required to purchase and your credit period to customer is slightly higher, then obviously that gap needs to be funded by working capital. Again, ideally, this can be funded from your own sources if you have, otherwise, you need to go to the bank. When it is a requirement to go to a bank for taking up either a term loan for long term funds or working capital loan for funding your working capital gap, the first requirement is preparing your business plan and project report with financial projections for at least 5 years or 7 years, depending upon the term of your term loan requirement. Right? So, in this particular project report, you need to incorporate entire details of the business, as we have already discussed in the past episodes, and you also need to clearly give the funding requirement, the various dynamics that affect the financial requirements, and how you are going to manage. And you have to clearly give the gap in working capital, gap in Capex funding, for which you are approaching the bank. And the bank will be interested to evaluate the project mainly based on how well you are able to manage your business with limited funds, with efficient fund management, and what is the quantum of own funds you are going to bring into the table. A lot of times, it's unfortunate that people feel I will not put my own money, but I will depend completely on banking funds. That is not a great way to do business. You need to have your own investment into business, and you need to part fund by bank and not fully depend on banks for your project closure. Your working capital requirement will be basically depending on the nature of your business. A typical open cash credit depending on materials and receivables, or OD arrangement based on your mortgage property, or if you are going to import, then you may require a foreign letter of credit. If it is domestic purchase, maybe inland letter of credit may be required. Sometimes bank guarantee requirements will also be there. Clearly assess how I'm going to fund my whole working capital and then go to the bank for assistance. As long as the balance sheet depicts a strong picture, you don't have to worry about anything else, particularly with regard to the rating. Now, going forward, relationship which you maintain with the bank is very important. It has to be a healthy, transparent relationship between the bank and the customer, and also a disciplined operation of your bank account is critical for a long-term proper relationship with the bank. So what we mean by disciplined banking relationship is all your credits should be properly routed only through the bank account, and every payout should be only through the bank account, and it should just reflect your entire P&L account. Your credit summation as well as the debit side of the bank account should be reflecting. Now, moving forward, every month, please make sure you check the interest what is being debited. It has to be verified and validated by the finance department. Keep monitoring the cost of funds so that time and again you need to go to the bank and sit with them, discuss, and see the possibilities of reduction of cost of funds. Negotiating the proper interest rate is also very critical. Please take care of that. Last point, but a very important point in banking side is, if the bank is going to insist on personal guarantees, please think if they discuss with the bank if you can avoid it. Because if you're going to give a personal guarantee, which means your liability is not limited to the capital which you have invested in the business, whereas it extends beyond that and beyond to your personal assets also. So it's important to plan your collateral securities accordingly and then talk to the bank. Try to also avoid giving house property, personal house property as collateral security. Always Mixing personal assets with business assets should be avoided. Ultimately, the purpose of business being wealth creation, it should not work in the opposite way of wealth depletion. So these are the points which are very important to take care. And the crux is financial planning, financial closure well before commencement of business is the critical thing. And make sure it is on your table, paka. Right? With this, we come to the end of this episode. Any queries, please address to this particular email ID. Please make sure you like, subscribe, and to this particular channel so that you always get the notification of future. So till you and me meet the next time, goodbye and all the best.